The stock market is crazy and so is volatility. Just a week ago, we have a sharp correction down, broke the 100, coming close to the 321 support level, and this week we have the totally opposite scenario happening. In just 5 short days, the SPY has shot up all the way back to near its all-time high. And we can see a very clear cut and nice breakout over here. So this resistance doesn't work anymore. And in fact, even though it is near all-time high, it is still not making higher highs yet, right? If we can reposition the resistance line to something like that, it has still not cleared the overall resistance. So will this line continue to act as resistance to the prices? Or can prices break through this line and make even higher highs subsequently? We'll have to wait and see. While such a huge and strong rally normally mean good and bring in profits for the portfolio, I can only wish so for my own portfolio. That's because we have been dealing with quite a lot of costs, and such a huge upswing in stock prices generally just do not sit well with my portfolio. And in fact, my cash flow for the week has been taking quite a hit. So these are the positions that we have today. Expiring today, the 6th of November, will be the Bank of America, AbbVie, and a new cash secured put for Starbucks, right? Sold at a strike of 85. So we will talk a bit more about Starbucks later in the video, so stay tuned for that. And if you are wondering what happened to the Apple calendar spread, I've already rolled it out and up earlier in time. So this is the short call that you would be looking for. It is now having an expiry of 13 November, and if you recall from last week's video, we sold a strike at 115. So for that call, I've rolled it up to the 116 strike call. So this is the trade history for the trade itself, and you can find it over here, the rolling of Apple. And for that, I've collected a net premium of 35 cents credit. So that's 35 cents more into the trade if it gets to expire worthless by the end of next week. So if you take a look at Apple, price action behaves similarly to the SPY, right? So this week, it experiences a sharp rally, and the 115 strike call that I've sold last week has got into the money. And because of that, I've rolled it out early in fear that stock prices will continue to skyrocket in today's market. So if we go over to the option chain, this will be what you will be seeing. The 115 strike call that we have sold last week is currently going for 360 to 375. Yesterday, I've rolled it at $4 over in terms of its premium. So if you are questioning why did I roll this 115 short call into the 116 strike instead of rolling it further out of the money or at the money, that's because I want to ensure that I get a minimum credit when I roll my options forward. So if we roll the 115, buy to cover, and then we sell the 116, you can see I can still collect 35, 37 cents in terms of credit. And if I were to roll the 115 out, further out, let's say the 119 strike, you can do that as well. But to do that, you will have to pay a debit of $1.44. So where will this $1.44 come from? You will have to deduct this from the earlier premiums and profits that we have collected from selling the cost. I do not want to do that, and therefore for now I'm just slowly rolling it out bit by bit, hopefully one strike at a time until the short call can expire worthless. And of course, there will definitely be some risks involved to each alternative that I've just mentioned. Following my course of action, this is the current risk profile of the entire trade, taking into account all the previous premiums and profits that I've gathered so far. So stock prices is currently here at 118.6. With that, my break-even prices for this entire trade will be at 101 and 139, 140. So that is still rather far, and therefore my previous profits that I've collected should be rather safe. So this is one scenario. And let's say if you choose the second option that I've mentioned previously, that is to roll it further out of the money. And just take a rough example. This will then be somewhat of your risk profile. Alright, so that is for the first scenario. Our max profit will be at somewhere around 740. And if prices stay put, the max profit will be about $660. And if you were to follow the second scenario that I've mentioned previously, then perhaps take for a rough example, this may be what your risk profile will look like. Generally, your break-even will have shifted from 106 to now 141, slightly skewed towards the upside in price. And also, your max profit will be slightly lesser. Right now, you are just looking at a max profit of 720 if prices can stay at 118 or 119 by next week. So pros and cons to consider and weigh if you are in my shoe the next time this happens to you. Alright, so the Apple short call did not bring in any cash flow for our portfolio this week. Next, let's look at Bank of America. The cash secured put sold at 24.5. Bank of America currently is staying at the money, 24.49, 24.5 around there. What I'm going to do is roll it out into next month's expiration. Chart wise, there's really nothing much to discuss about. It's just hovering around these two boundaries that we have been mentioning time and again. So if we were to look at the option chain, I will just buy it back, the 24.5, and then we will look at the 4th December expiration. So for this, I'll collect a net premium of 65 cents. And 65 cents divided by the strike price of 24. This in itself is a 2.7% yield. So not bad, 2.7% in a month. I'll just take it. All right, so let's just wait for it to get filled. Moving on, we have AbbVie. AbbVie was in a huge downtrend ever since we looked at it last week. But right now, the 87 strike call that I've sold is deep in the money. I've sold this for a premium of 150. Right now, it is going for 535 in the market. So let's look at AbbVie and see what happens. And this is it. So generally, the earnings for AbbVie went rather well. And after earnings have reported, prices just kept up and up and up non-stop. All right, so I've sold the 87 strike call somewhere during this candle, I believe. And after that, prices just keep skyrocketing. And if we were to look at the oscillators, right now, FV is heavily overbought, right? It is way above the Bollinger Band. Stochastic is above the overbought territory. And RSI is also above the upper boundary. All right, so that's just a more in-depth analysis of the stock. Generally, what this means for our stock position and our covered call position is that we'll be able to exit both of them with a slight profit. If you recall, our break-even price for AbbVie is somewhere around $87. With this huge increase in prices, our stock position will have gained a lot of profit. But at the same time, the covered call that we have sold at 87 strike will have incurred a huge loss, like we have seen previously. So AbbVie call that we have sold is currently down $390. But if we take a look at our stock position over here against the trade price of 88.40 cents, this is non-discounted. Remember that we have been selling a lot of expired calls on it, and the premiums that we have collected would have discounted the price by a fair bit. But even if we look at non-discounted trade price, we are still looking at a profit and loss of 393. So what does this tell you? If I exit these positions at the same time, essentially it is a break even for me. And if you take into account the previous premium that I've collected from selling the call options and also the dividend itself, I will have made a slight profit for this trade. Let's exit it and then I'll log it down for you to see. Alright, so I'm just going to sell all of them, and before that I would like to edit my prices. So I'll be selling 100 shares. Currently market is going for 92 and 35, 36. So let's just go for that. Alright, so once it has been sold, I would like to immediately close out my option position. It's currently going for 540, so let's just trade at that price. Alright, so both have been closed out. And let's calculate our profit and loss for this trade. So this is my trade log. So I'm just going to log in 92.34 for the sales of AbbVie. And for the transaction fees is 21 cents. Alright, so I have exited it at a price of 540, and the commission for this is 71 cents. Alright, so the dividend obtained after accounting for the withholding taxes, I'll have received $82.60. This is the trade result. So from the stocks itself, I've profited $393, close to 394. Options, I've lost 260. Dividend 82. So my total profit and loss for this entire dividend capture trade for AbbVie is at $215.80. Alright, so before even accounting for dividends, you just take the stock's P&L deducted by the loss in options. We still have made a slight profit from the trade of these two alone. And this is further boosted by the dividends. Right, the downside of this trade is that it takes slightly longer because AbbVie was in a downtrend previously. Right, so this whole trade took a total of 25 days. And with a return of investment of 3.86%, this is calculated against the total capital that I used to purchase the 100 shares of AbbVie. If you translate this to an annualized return, we'll have a 56% annualized return. Slightly lesser if you compare to our previous trade, BAC JPM. But it's still good nonetheless, and now that we've gotten rid of FV, I can finally breathe a sigh of relief. And that leads us to our next trade that I would like to talk about, and that is the Starbucks cash secured put at 85 strike. Alright, so if you're sharp enough, you would have realized that this cash secured put was in preparation to own the Starbucks shares for the next dividend capture strategy. The next stock that I'm eyeing for its dividends is Starbucks itself. So basically, I've sold the cash secured put for Starbucks somewhere on Tuesday of the week. That's after I saw prices for AbbVie shooting up way above our short call of $87, right? So after that happens, I think that most likely we are able to offload AbbVie and finally get back the cash that is locked into the shares of AbbVie. And with the cash now freed, I will be able to purchase the next stock for its dividend. And therefore, I went ahead of time and sold the cash secured put for Starbucks. Right, so the cash secured put was sold when this candle was still forming, and basically I played it a bit safe. So I sold the 85 strike put, which is somewhere around here, right? Still below the low of the lowest candle. So this is just in case the market suddenly makes a huge downturn and then I'm not able to get out of AbbVie fast enough, at least I do not have to fork out that much cash for Starbucks. But my plan turned out to be alright, all thanks to the huge rally in the overall stock market. So right now that the Starbucks cash secured put have expired worthless, the $1.19 worth of premium can be used to offset the drop in stock prices after I acquire the shares. So I'm going to leave the buying of Starbucks shares on to next week, since right now you can see that it is currently at the high and also facing a resistance of $91.35. So prices have previously peaked out over here once, twice, and the third time, all at similar levels. So perhaps the $91 may be acting as a strong resistance. And if that's true, maybe prices can retrace a little bit next week and allow me to buy at a slight discount. Alright, so after I purchase the shares, then I'll sell the covered calls and we'll wait to collect its dividends on the 10th of November. Alright, so let's go ahead and force fill our Bank of America trade. Alright, so it's filled at 64 cents. And if you recall from last week's video, we also have the EEM and FXI covered calls, all of which I've already rolled out earlier in this week to another month of expiration, right? And that is because of the huge rally that we have seen in the general market. So along with that, EEM and FXI all shot up way above the strike that we have sold. And basically all our cover costs were all very deep into the money. EM, I have one at 45 and 45.5, so that is somewhere around here, and you can see just how far prices have went. So I have no choice but to roll it out into next month expiration. For EM, here they are. The 45 I've rolled it out into 45.5. The 45.5 strike I've rolled it out to 46 strike. Alright, so these are the premiums that I've collected for rolling them. As I've mentioned before, when rolling, for now, I would like to at least receive some form of premium. So these are the trades that I've performed a few days back, and you can see minimally I received some form of a credit. So whether or not this strategy of rolling will work out, I'm still exploring and finding out its pros and cons over other alternatives. And I'll be sure to share with you my findings as soon as I realize or learn something new. So that's for EM, and FXI is the same, right? Stock prices have shot up crazily. And in fact, FXI was worse because FXI, we have a short call of 43.5 and I could only roll it out to 44 for a net premium of 20 cents. And if we go back to the chart, $44 is way below where stock prices are at right now. So hopefully stock prices can retrace back, ideally to below my strike price. Alright, so once again, cash flow this week for the account has been tight. Basically, the only positions providing cash flow is the Starbucks cash secured put and the Bank of America cash secured put. And for the Starbucks, I'm just going to leave it to expire. How has this week been to your portfolio so far? Share it with me in the comments below and I look forward to hearing from you. Once again, thank you so much for watching. Do remember to smash the like and subscribe button and I'll see you in the next video.